Imagine waking up one morning and seeing something that feels almost unbelievable. But it's real, and it's happening right now. Silver is not just moving, it is exploding. We're talking about price action so dramatic that even the boldest traders from past cycles are scratching their heads. A year ago, silver was around $30. Today, it's trading near 15. That S, not a little blip, that S roughly a 270% gain in just 12 months. To put that in perspective, Bitcoin didn't do that, Tesla didn't do that, Nvidia, the S&P 500, forget about it, silver did. And the wild part is, this may be only the beginning. Now, before you roll your eyes and scroll to the next video, hear this. What's driving this move isn't some irrational craze or internet rumor. There's a very real pivot happening behind the scenes that most people have completely missed. Let us break down what is going on without the financial speak that makes your eyes glaze over, and why this could be one of the most consequential windows in your lifetime. Earlier today, something quietly significant happened at 9 a.m. Eastern Time. While most of us were starting our day, the Federal Reserve, specifically the New York Fed, executed what they call a Treasury bill purchase operation. They bought $8,304 billion or $30 worth of short-term government debt. That might sound like dry Federal Reserve stuff best suited to an economics textbook. But what it really means is this. The Fed created $8.3 billion out of thin air and injected it into the financial system. No taxes were raised, no savings were used, no loans were repaid. Poof, new money conjured by a few keystrokes. Most people see numbers like that and think, okay, that's nerdy stuff for economists. Next video. And that reaction is exactly why most people never get ahead financially. Because if you actually understand what that means for assets like silver, you need to be paying very close attention. Here's why this matters so much. This isn't a one-off event. In fact, it was the third injection in a week. Part of a broader program the Fed quietly announced late last year. They call it Reserve Management Purchases. Try saying that 3 times fast. But beyond the boring title, what it actually means is that the Fed plans to create fresh new money at a rate of roughly $45 billion per month throughout 2026. That is about $540 billion over the course of this year alone. $500 billion flooding into the financial system. That's not speculation. That's their own published policy available on the Federal Reserve's website. Now for anyone to read. And yet, you won't see this discussed on CNBC's headline segments. Bloomberg won't air this on their morning market wrap. Most financial advisors have no idea this is happening. They've never even heard of reserve management purchases. But you know who does know about this? Some of the biggest players in global finance. Take Ray Dalio, founder of Bridgewater Associates, the largest hedge fund in the world, overseeing more than $150 billion. He's been openly accumulating gold and other real assets for years, repeatedly warning about the risks of currency debasement. Then there's Stanley Druckenmiller, one of the greatest traders of all time, the man who helped George Soros break the Bank of England. He's been publicly bullish on hard assets as well. And perhaps most tellingly, Jamie Dimon, CEO of JP Morgan Chase, a guy whose entire career was built inside the dollar system, recently admitted something remarkable. After 5 decades on Wall Street, gold is finally making sense as an investment. Let's dwell on that for a moment. When the most seasoned veterans, trained to thrive within the current monetary framework, start openly advocating for hard money, something is shifting beneath the surface. So what's actually happening? Let's strip away the jargon. Between December 2005 and December 2025, the Federal Reserve balance sheet skyrocketed from about 800 billion to roughly 6.5 trillion. That's an 800% increase in just 20 years. To put that in real terms, one institution, staffed by unelected officials, now controls assets equal to more than 20% of the entire U.S. economy. That's not a small number. That's not something you shrug off. Over that same time frame, silver's price went from around $7 an ounce to $115 per. That's roughly a 1,500% increase, nearly double the pace of the Fed's balance sheet expansion. The correlation between money creation and silver price growth is unmistakable once you actually look at the math, not the headlines. Now, here's where the story gets truly interesting. I recently spoke to a coin dealer with over 30 years of experience in precious metals markets. This isn't some guy selling trinkets on eBay. He has lived through the 2008 financial crisis, the 2011 silver spike, the COVID crash, and every twist and turn in between. And he told me something that, frankly, stopped me in my tracks. Down in December, those customers were offering 20% over spot price just to get their hands on physical silver. Historically, premiums over spot are typically around 5% for retail buyers, maybe slightly higher in tight markets, but rarely 20%. And yet people were calling this dealer every day, pleading, begging, willing to pay any premium, and he still couldn't source enough silver to meet demand. After 3 decades in the business, he said he's never seen anything like this. That kind of behavior tells you something very important. People are waking up. They're not just watching prices rise. They're actually reacting to what they perceive as real scarcity, or at least the fear of it. Now let Mass talk about something that's fundamental to understanding where silver might go next. The two behind gold to silver ratio. It's really simple. You take the current price of gold and divide it by the current price of silver. The result tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, when you look back over decades, that ratio averages somewhere around 50 to 60 kroner. Right now, with gold around $1,500 and silver at about 115 last, the ratio is roughly 145 to 1:1. Here, as where it gets juicy, history shows that when that ratio gets stretched either too high or too low, it eventually snaps back. And when it snaps, silver doesn't just inch higher, it often explodes. Let's look at a few examples without getting lost in the weeds. In 2010-2011, the ratio fell from around 70 to nearly 32. And during that compression, silver went from about 18 to nearly $50, almost a triple in about 14 months. In 2021, during the COVID market panic, the ratio spiked all the way to 125, driving silver down to roughly 1. But once the ratio began compressing, silver rocketed back up to nearly 30 in a matter of months, more than doubling. These aren't random blips. They repattern cycles that repeat when markets are driven by liquidity, fear, and reallocation into real assets. Right now, we are in the early stages of another compression cycle, and that AS, where the real opportunity lies. Let's run some numbers. Real, clean, simple math. If gold stays near $100 and the ratio compresses to 30 to 1, similar to past cycles, silver would move to $170. That's about a 52% gain from where it is now. If the ratio compresses further to, say, 20 to 1, silver would hit 255, 127% gain of higher. But wait, that assumes gold stays flat. What if gold keeps rising? After all, major institutions are forecasting higher gold prices. JP Morgan recently raised their official target to $5,500, and independent research firms like Yardeni are talking about $6,000 gold in the coming year. If gold reaches 6,000 on variance and the ratio moves to 30 to 1 silver would be around $200. If gold hits $6,000 and the ratio compresses all the way to 20 to 1, silver would jump to $300. From the $115 to $300, that's about a 168% gain, and that is not fantasy land. That is based on historical patterns and straightforward math. Now, I'm not here to tell you to go all in and risk everything. That would be irresponsible. But let us be honest, if you are sitting with us, 3 months of expenses in a savings account earning 4%, while silver is delivering 270% returns. You're not being conservative. You're being slow. You're not playing defense. You're watching opportunity walk past you. This is not a drill. This is not speculative internet hype. This is real macro liquidity expansion, real shifts in financial positioning by major players, and real historical patterns that have repeated themselves time and again. So keep your eyes open. Keep your mind engaged. And understand this, markets are not going to wait for you to catch up. Let us start with a slightly uncomfortable truth. Leaving all your cash parked in a savings account right now might feel safe, but financially, it is a bit like standing on an escalator that is slowly going down while you insist you are staying in the same place. You're not. Inflation is quietly chewing away at your purchasing power, month after month, while your bank thanks you with an interest rate that barely buys lunch. Meanwhile, over the past year, silver holders didn't just preserve purchasing power, many of them multiplied it. Now, before anyone gets carried away, this is not a call to empty your bank account and build a vault in the backyard. That would be reckless. But having zero exposure to hard assets while the Federal Reserve is on track to create roughly $540 billion this year, that's a different kind of risk. The quiet kind people only notice in hindsight. So let's talk about what's happening beneath the surface, especially in the physical silver market, because this is where things go from interesting to, okay, that's a bit wild. Here's something you can check yourself. Look up the COMEX silver inventory figures, not the headlines, not the opinions, the actual registered silver available for delivery. Mid-2025, those vaults held around 86 million ounces of registered silver. Recently, that number has fallen to roughly 28 million ounces. That's a drop of about 2/3 in a matter of months. The pool of metal that can actually be delivered against futures contracts has shrunk dramatically. Now here's the twist. While physical inventories have been sliding, the number of paper silver claims hasn't fallen with them. There are still hundreds of millions of ounces worth of contracts outstanding. Far more claims than there is readily deliverable metal. The ratio works out to dozens of paper claims for every single physical ounce sitting in those vaults. If that sounds abstract, picture an airline selling 33 tickets for every seat on the plane. It works fine as long as most people don't show up. But if everyone suddenly decides they want their seat at the same time, you've got chaos at the gate. That's the kind of structural tension people are starting to notice in silver. Another signal flashing right now is something most non-specialists never hear about: silver lease rates. These are the rates industrial users or traders pay to borrow physical silver. In normal times, lease rates are boring, fractions of a percent, maybe 1%. Recently, they've spiked to levels not seen in decades, reportedly around 8%. Think about that. Companies are willing to pay 8% annually just to borrow silver temporarily. You only do that when you really need the material and can't easily source it outright. No one pays premium financing costs for fun. Elevated lease rates are a classic sign of tightness in the physical market, and historically, major spikes have often preceded strong upward moves in price. Then there's what's happening internationally. In some parts of the world, physical silver is trading at noticeable premiums over futures prices. In Shanghai, for example, buyers have at times been paying several dollars more per ounce for immediate physical delivery than the quoted paper price suggests. That gap between paper and physical markets is a sign of stress, the real-world supply-demand balance not lining up neatly with derivatives pricing. And we've seen similar dynamics in other metals. In 2022, nickel experienced a dramatic short squeeze when physical supply tightened and paper positions were forced to unwind. Prices went vertical in days. Trading was halted and exchanges had to step in. Silver is a much larger, more established market, so no one can say if anything that extreme will happen. But the ingredients, heavy paper positioning and tight physical supply, are familiar. This is one reason many sophisticated investors emphasize owning at least some physical metal rather than only paper proxies. ETFs and futures have their place, but in periods of market stress, direct ownership removes counterparty risk. When the game of musical chairs gets tense, people tend to prefer having an actual chair. Supply pressures aren't just about inventories and lease rates. Policy shifts are also entering the picture. China, a major force in the global silver refining and supply chain, has introduced tighter controls on silver exports. While not an outright ban, the new framework restricts exports to a smaller group of approved companies meeting strict criteria. That effectively narrows the pipeline of silver flowing from China to the rest of the world. Why does that matter? Because China isn't just another producer, it's a key processing hub. A significant portion of the world AS mined silver passes through Chinese refining capacity before reaching industrial users. When a country that's central to the supply chain starts treating silver more like a strategic material than a simple commodity, it changes the global flow dynamics. At the same time, government mints have been dealing with volatility of their own. There have been periods where official bullion coin programs temporarily paused or limited sales, citing rapid price movements and supply constraints. When sovereign mints struggle to keep products in stock, it's usually a sign that retail demand and wholesale supply are colliding in uncomfortable ways. All of this would be interesting enough if silver were just a shiny metal people like to stack in safes. But the demand story is arguably even more powerful, because modern silver consumption is deeply tied to technology. Silver is one of the best electrical conductors on the planet, and that property makes it essential in a long list of applications. Solar panels are a big one. Each panel uses a small amount of silver in its conductive paste, and when you multiply that by hundreds of millions of panels, the ounces add up quickly. Solar demand alone has surged in recent years and is projected to keep growing as countries push toward renewable energy targets. Electric vehicles are another piece of the puzzle. EVs generally use more silver than traditional internal combustion vehicles due to their heavier reliance on advanced electronics, power management systems, and connectivity. As global EV production ramps up, so does embedded silver demand. Then layer in 5G infrastructure, data centers supporting artificial intelligence, advanced medical equipment, and consumer electronics. Silver's antimicrobial properties make it valuable in medical settings, and its conductivity keeps it indispensable in everything from smartphones to high-performance computing hardware. It is not an exaggeration to say that many of the defining technologies of the next decade are quietly silver-intensive. Here's the catch. For several consecutive years, global silver demand has exceeded newly mined and recycled supply. That creates structural deficits, not just one-off shortages, but ongoing gaps that have to be filled by drawing down inventories. Over time, those drawdowns add up, tightening the market further. Put all of this together: aggressive monetary expansion, tightening physical inventories, rising lease rates, policy shifts in key supply countries, and accelerating industrial demand, and you get a market that's fundamentally very different from the sleepy silver market many people remember. Does that guarantee prices will only go up? Of course not. Markets don't move in straight lines, and silver is famously volatile in both directions. Sharp pullbacks are part of its personality. But dismissing it as a relic, while these structural forces build in the background, might be just as risky as going all in without a plan. The rational middle ground is awareness and balance. Understand that cash carries its own risks in an inflationary environment. Recognize that hard assets like silver have historically played a role during periods of monetary expansion and industrial transformation. And make decisions based on your own time horizon, risk tolerance, and financial goals. Not hype and not complacency. Because whether people are paying attention or not, the silver market is no longer a quiet corner of the commodity world. It's becoming a pressure point where monetary policy, geopolitics, and next-generation technology all intersect. And those intersections are rarely boring. Step back for a second and look at the big picture, because this is where the silver story shifts from interesting trend to structural shift. Last year alone, the market ran a supply deficit so large it nearly matched an entire year of global mine production. According to industry data, 2025 recorded the biggest silver shortfall ever measured, roughly 295 million ounces more demand than supply. That metal didn't come from nowhere. It came out of stockpiles, vaults, and buffers that took years to build, and those cushions are getting thinner. Here's something most people miss. Higher prices don't magically fix silver shortages. Silver isn't like oil, where a price spike can quickly bring new drilling online. Around 3/4 of global silver production comes as a byproduct of mining other metals like copper, zinc, and lead. So even if silver prices double, a miner can just flip a switch and produce more unless the economics of those base metals also justify expanding operations. On top of that, developing a brand new mine is a long, expensive process that often takes close to a decade. Add in declining ore grades worldwide, meaning more rock must be processed for the same amount of metal, and it becomes clear there is no fast supply cavalry riding in to save the day. This is a structural issue, and structurally tight supply tends to be a long-term tailwind for prices. Now let's talk timing, because markets care not just about direction, but about when pressure builds. There's a window right now that deserves attention. The Federal Reserve's current reserve management purchase program is scheduled to run through April 2026. That means, on paper, a known pace of liquidity creation for the next few months. After that, uncertainty rises sharply. The leadership transition at the Fed later this year could bring a different tone or policy mix, and markets don't like ambiguity. When visibility is limited, capital often moves ahead of the fog, not after. Big players seem to be positioning accordingly. Central banks have been accumulating gold at one of the fastest paces in modern records over the past few years. While gold gets most of the headlines, silver tends to ride the same monetary currents, often with more volatility. Meanwhile, investment flows into silver-related products have picked up, and exchange inventories continue to trend lower. Metal is leaving vaults and not quickly returning. That tells you someone, somewhere, is choosing to hold the physical stuff rather than just trade paper claims. Analyst forecasts are also racing to catch up. Large banks that once projected much lower silver prices have already seen their targets overtaken by the market. More aggressive independent researchers are now discussing scenarios that would have sounded extreme not long ago, triple-digit silver becoming a base case rather than a stretch case, especially if gold continues higher and the gold-to-silver ratio compresses toward historical norms. If gold were to reach levels some firms are now discussing, and the ratio tightens significantly, the math alone points to silver prices well above where we are today. That doesn't guarantee anything, but it explains why attention is growing. Of course, none of this removes risk. Silver is famously volatile. It can surge quickly and correct just as sharply. A severe global recession could dent industrial demand. A surprise shift toward much tighter monetary policy could pressure precious metals broadly. Anyone considering exposure needs to be comfortable with swings and size positions accordingly. Diversification and time horizon matter more than bold predictions. Still, it's worth lining up the observable facts. Monetary authorities are still expanding liquidity. Key supply channels face constraints and long lead times. Above-ground inventories have been drawn down by consecutive years of deficits. Industrial demand tied to energy transition, electrification, and advanced technology continues to grow. These are not rumors, they're measurable trends. Whenever markets move like this, people tend to fall into three camps. One group dismisses the whole thing as a bubble, convinced it's already too late, often after saying the same thing at much lower prices. Another group understands the argument, but waits endlessly for the perfect entry that never quite arrives. The third group does its homework, checks the data, and makes measured decisions that fit their own financial situation. Only you can decide which category you land in. History offers perspective. In past precious metals cycles, silver has delivered explosive moves over relatively short periods, followed by deep pullbacks and long consolidations. Adjusted for today's money supply and inflation, prior peaks would translate to prices far above levels that once seemed unimaginable. The drivers this time are different, though. Earlier spikes were fueled largely by financial speculation and attempts to corner the market. Today's demand includes a heavy industrial component tied to long-term technological trends. Solar installations, electric vehicles, grid upgrades, and data infrastructure don't disappear overnight. If anything, they're scaling. There's also the macro backdrop. Decades ago, aggressive interest rate hikes eventually crushed precious metals rallies by making cash extremely attractive and tightening financial conditions sharply. Today, with government debt loads far higher, the tolerance for ultra-high rates is arguably lower. That doesn't mean rates can't rise, but it complicates the policy path. Markets know this, and metals often respond to those constraints. Zooming out, compare recent performance across asset classes. Traditional stock indices have delivered respectable gains. Some digital assets have done even better in certain stretches. But silver, after years of underperformance, has suddenly outpaced many mainstream investments over the past year. And yet, it remains underrepresented in most portfolios, partly because it rarely dominates financial headlines. None of this is about hype or slogans. It's about understanding how monetary policy, supply dynamics, and industrial demand intersect. Hard assets like silver don't generate cash flow, and they don't fit neatly into every strategy. But in periods when currency creation accelerates and real-world materials become more strategically important, they tend to re-enter the conversation in a serious way. At some point down the road, you'll look back on this period and have an opinion about it. Maybe you'll conclude the concerns were overblown and markets normalized smoothly. Or maybe you'll see it as a turning point when structural forces pushed certain assets into a new pricing regime. The key is not guessing perfectly. It's being informed enough that your decisions are deliberate rather than accidental. So take the time to verify the data, understand the risks, and think about where silver, or any hard asset, fits, if at all, in your broader plan. Markets reward preparation more often than they reward certainty.